Hi there, and welcome to our weekly webinar. I'm excited to be giving my forecast for 2025. I did get to share this at our live event. It was so awesome. If you were there, it was just really great to see you. Wow, we had way too much food. I hope your tummy felt fine after that. All right, so I'm going to go ahead and share my screen, and I'll go through this presentation, and then I can uh, take questions at the end. So investing in 2025 and beyond. This is the topic for today. It's a housing forecast, but also I wanted to go back to a reminder of how and why real estate works in any market, and specifically today. So let's just start with this concept of only owning a rental property that you borrowed the money to acquire it. Somebody else is paying it off for you. They're paying your mortgage, and there's extra to put in your pocket as cash flow or to pay for reserves for the property. You have asset protection on it, and then someday you could have it paid off maybe in 30 years or maybe less, maybe 15 years if you just made one extra payment every year. So you could just take the cash flow from the property, make that extra payment, and you can radically reduce the amount of time it takes to pay off that property. So imagine that having a paid off property that cash flows for you. And now imagine that you bought 10 of these little golden geese, I'd like to say, that not only cash flow, but maybe you've taken all that cash flow, paid them down in 15 years, and you own 10 properties free and clear. Would that change your life? If you were making $1,000 per property, or let's say 2,000 in cash flow, what would your life be like today? Who would you be spending your time with, and what would you be doing? Because at the end of the day, it's why we're in this industry. It's not because everybody just wants to own a bunch of homes and deal with tenants and property taxes and all the things that come along with real estate. It's what you get. And one of the reasons why I love our live events is I get to see some people who have done this and started with us 20 years ago, trusted us on this process. Rich and I, are one of them. We started investing out of state 20 years ago, along with many of our members. And some of them showed up at the event, and it was so fun to see them 20 years later. And trust me, 20 years does go by. It goes by really, really fast. And here, are these people living this dream, having bought maybe a property a year or a couple of properties a year till they got to the point, they had the plan, they were able to execute it, paying off that one extra payment per year to pay these things off so that they do own the portfolio free and clear. Or they refi, take that money and go buy more. What's so nice is that if you have a lot of little properties, you are more diversified than if you just had one. And I say this because so many of our investors at Real Wealth are from the San Francisco Bay Area or from Los Angeles, where they maybe did this plan. They bought a house, they had someone else paying down the loan, and now that property is worth double, triple, maybe quadruple what they paid. And yet the rents didn't do that. The rents only went up a little every year. So they're not really seeing, they're not really seeing the cash flow they could get from that property. And they have all their eggs in one basket. So let's say they bought a house for $500,000 and it's worth $1 million or even $2 million today. But the rents might be 4,000 a month. That's a lot of rent, but it's not for all the equity sitting in that property. So, and let's just say there was a fire. Oh my gosh, I'm sitting here in Malibu, know all about these fires. And I know someone whose rental property was burned and she didn't have enough insurance on it. So, what if there was an earthquake or a fire or something and that one property went vacant, but you still have all the expenses on it? Wouldn't it be wiser to sell that property and 1031 exchange it into several properties that are spread out so that that climate risk is mitigated somewhat, or economic risk of an area? In 2001, we know that the San Francisco Bay Area had a recession. It was the tech recession. But Dallas wasn't having that. They were having a boom. So diversification, it really helps you sleep at night. Because think about it. If you took that one property and 1031 exchange it, sold it, and bought 10 properties around the country, if even 50% of them went vacant, you'd still have more money than if your one property went vacant because you're 100% out of luck when you have one property and no one's there. And in California, it's a lot easier for someone to live in your property and not pay. So I really just wanted to come back to the fundamentals of owning real estate and what it can do for you so that you can live life on your terms, living off that cash flow. But a lot of people come to us, and my nephew was at our live event last weekend. He's in his 20s, maybe he's in his 30s now. But he might be questioning, well, yeah, Auntie, it worked for you. You got in before this crazy 15-year upcycle where prices have only gone up over since 2009. But what about me? Today, can I do that? Or is it just a boomer thing? Did the boomers just get lucky? So I get it because we have one of the worst affordability crises ever. I think the last one was in the 80s, where housing is just out of reach for most people. Mortgage rates are at a 20-year high. They're still historically low. When you look at this, it's like, wow, we've definitely been here before. In fact, the low rates we had was more rare than where we are now. But people just aren't used to it. Plus, in addition, we're at record high home prices. So record high home prices combined with average mortgage rates, but double what they've been, that's made it really, really unaffordable for a lot of people. So oftentimes I hear an argument of, it's too late. You're not going to make any money in real estate. Put it in stocks and bonds. Look what stocks and bonds have done. And it's true. This red line here is stock prices, and it's boomed. It's been crazy. And real estate has gone up, but not to the extent that the stock market has. So people have often said, yeah, why wouldn't I just do something much easier, like put it in the stock market? But there's one really, really big problem with this theory. And it's the theory that you're going to buy your property all cash. So not everybody does that. If you buy a property with all cash, you're obviously going to cash flow better than if you have a loan on it. But if you're really looking for the overall return on the property, you've got to include leverage. I'm going to give an example of how this plays out. Let's say that Joe bought, he has $100,000. A lot of people ask that. What should I do with $100,000? All right, well, you could go buy gold or bonds, something that gives you safety. And so you've got $100,000 worth of value. Now let's talk about Mary, who took that 100,000 and she's kind of going big. She's going to buy stocks on margin. So she's able to buy $200,000 worth of stocks with her $100,000. And then you've got Pat. Pat uses that $100,000 as 20% down to buy investment property. And because of that, now Pat has $400,000 in value. And so that's the baseline that we're using when we talk about growth, not the 100,000, but the value of whatever it is you've invested in. So assuming that all of these assets go up 5%, which in real estate is below the average, stock market as well. Well, Joe is super stoked because in 15 years, his gold is worth $207,000. So you'd subtract the 100,000 that he put into it, and he has a $107,000 profit. Kind of doubled his money in 15 years. Mary's stock is worth $415,000. She has to pay back that $100,000 mortgage and the capital and the fees and the interest rates. So she's done a little better than Joe, but not much in my opinion, for taking the risk that she took. Now, Pat, let's talk about Pat. The 5% appreciation rate on that $400,000 worth of property, Pat's property is worth $1 million in 15 years. Now, that $400,000 loan has been paid down to $200,000, and that creates a $700,000 profit. So we know who the clear winner here is, but it gets even better than that. Pat gets more bonuses. The properties weren't just sitting there like gold, or stocks where they're not income generating. Properties produce income. So on top of it, there's cash flow. And if we just took 5% of the 100,000 ago, cash on cash return, that would be an additional 75,000 in 15 years. That's a really low estimate. And if Pat were to put all that cash flow towards paying off the loan, all property would be paid off in those 15 years. So it would be $1 million in equity plus $60,000 to $75,000 in rental income ongoing, with pay raises every year as rents go up. So again, we have a clear winner here. There is just nothing that compares. And I haven't even included the tax deductions. So many investors who have bought a portfolio of real estate are able to take massive, massive deductions to the point where they pay zero in taxes. Imagine if you paid zero in taxes, how quickly you would gain wealth instead of, paying taxes, obviously. The more you make, the more you pay, and you think you're getting ahead until you write that check. I've been there so many times. And real estate is the government basically gives tax deductions for one reason. They want you to do something. So the government is saying, we want you to provide rental housing, because in the past the government provided rental housing, and it didn't work out so well. I mean, there's still, some of it, but Section 8, the government's still saying, we don't want to provide the housing. We'll just give you, we'll give the tenant the help they need, but you get the property and you get all, we want you to do this. We need rental housing. So we're incentivized to do so. The biggest mistake that people make when buying real estate is looking at year one and not considering all these benefits I just discussed. This is where you're going to lose out on opportunity by looking at year one, because I just pulled this property off our website. This is in Indianapolis, great market, by the way. Wonderful team. They're all wonderful. We just all met, at our live event and had a mastermind the day before. It's just an incredible group of people, high integrity, and obviously meet our real wealth standards. But let's just say $146,000 property. You've got this down payment. There's your cash invested. Then you've got, closing costs and so forth. Here's your rents. Well, you're paying the most this first year because of these closing costs, and because rents will most likely be the lowest they ever will be during the life of that property, because generally they go up every year with inflation. So the most important thing to look at when looking at property is year 5, year 10, year 30. That's when you can say, wow, I put $40,000 into this property, right? And in year 5, look at year 10, the kind of return I'm getting. It's pretty impressive. So again, remember, cash on cash return is the cash you put in versus the return you're getting. So to really simplify this, let's just say you bought a $100,000 property, you put $20,000 into it. Your real cash at risk, right, is the $20,000 as the down payment. But that property went up 5% in that first year. So that's $105,000 now that the property's worth. That's a $5,000 gain in year one, when you put in $20,000. So right off the bat, you made like a 25% return. And you're not even counting the tax deductions and cash flow from that. So again, biggest mistake people make is not calculating things that way, but instead, looking at if you were to pay all cash and compare it to the stock market, it's not the same. So again, the power of property is the leverage, being able to borrow money to acquire that asset. The government incentivizes you for doing it. Values go up over time. You can pass the property on to your children. When you pass away, the property goes up, steps up to market value, and they don't have to pay any of the taxes that you might owe on that. You can use one of our amazing asset protection attorneys to help make sure that you're anonymous in owning that property, and then you got the cash flow that you can either pocket or put towards paying down the mortgage faster. And just to kind of give an example of this. Generally, with a 30-year fixed rate mortgage, the first years are interest only. You're paying very little towards principal. But every year you pay a little bit more towards principal and less towards interest. So as you hold a 30-year note, these last years are amazing. That's when your property really gets paid down. So I say this because I don't want you refinancing your property at year 20. Be really careful about that because this is the time when every payment is really going to pay down that loan. Refinancing should happen early on, in my opinion, because not really that big a deal. You're paying mostly interest at that point anyway. But it's those last years that accelerate your wealth building. And when you make payments and that extra payment, the 13-month payment each year, then you bring that 20-year point much sooner. So literally you could pay it off in 15 years. But again, people say, did I miss it? Because look at the values, that have the cost of real estate. And just in the last 5 years, how high it's gone. Even with higher interest rates, it's insane how high prices are. So you might think, well, yeah, you started in investing out of state. Well, I started around here, but you can see it was still somewhat a bubble, went through this phase. But even if you bought at the peak and you just held, you'd be fine today because you'd have your loan paid down and you would see a lot of growth. But is it going to keep going or is it a bubble? This is the question. Here's my answer to that. It is a bubble. It is a bubble. And we can see it right here, a bubble in the money supply. So this is something way out of our control. But after COVID, well, really after the Great Recession, when almost everything fell apart in 2008, and Wall Street giants were toppling, that's when a new kind of financial engineering was created. And it really is just called money creation. I mean, they call it fancy terms, but they got real comfortable printing more money. And in the past, that wasn't a thing. In the 70s, back here, you can see that the money supply stayed pretty steady. And I remember when I was a teenager in the 70s, my dad would say, "Oh, did you hear they printed more money?" And it was like literally printing presses that were printing more money. And if it was $1 billion, that was a big deal. People got in big trouble for that. You could see that kept the currency stable. But then, politicians, the government needed more money for this or for that. So it became a little bit easier to do that. Well, after 2008, when the whole financial system was imploding, they just went nuts and they just were like, okay, this is how we do business now. We just create money. And you can see this bubble that's been created in currency, money that's circulating today. And if you talk to most people, they'll say there's no way going back now. Just this M2, this is the amount of money in circulation. Look at how much it increased after COVID. Almost, it was like $7 trillion, over 20 trillion worldwide because everyone was doing it. That amount of money that was created just out of thin air, just printed, but there's no printer, just a button on a computer. That was the amount of money in circulation in 2007. See right here, this amount of money that was created just in a matter of 18 months or so. So it is a bubble. It's like the banks just brought in a bunch more boxes of fake money. Like if you're playing Monopoly, everybody's trying to get the apartments on the board or the little houses. And you've got your box of money and you've got your dollars and you're making bids. And sometimes you can't afford it. Sometimes you can. The goal is to get as many as you can. Well, then the bank brings in a bunch more boxes of money and everybody gets more money, but they haven't increased the number of houses or apartments on the board. That means everybody can bid it up. You have more money to bid up what's there. So that's basically what's happened is the value of real estate hasn't gone up. It's just that there's more money chasing it because it's been financially engineered. Is it a bubble? Yes, but they're not going to be able to unwind this. This is kind of just where we are today. I bring this up because as investors, we have to look at things differently. And I imagine that Robert Shiller is an investor, but he also, is a data analyst. And so when I debated him on Fox News in 2012, he said, and that's right here, he said, it was a dangerous time to buy real estate. And my argument in this debate was it is the best time ever. This is the greatest wealth transfer in history. And the fact that I actually at the end of the interview he agreed with me because I was like, coming from an investor perspective, homes are a fourth of what they were just a few years ago, and yet rents have stayed high. But also, if you're a renter wanting to buy a house, that means your mortgage is going to be about a fourth of what you're paying in rent. Why would you not buy? Like, how is that dangerous? So I guess for him, he was looking at this downtrend because if you're looking backwards in the rearview mirror, which data analysts do, you're only looking at data from the past. Well, yeah, you would be like, oh, wow, every year prices are going down. From my lens, I was looking in the future. Well, there's only a limited number of homes. Builders stop building because why would they build? No one's buying. And yet people need a place to live so we can buy these houses at low prices, but the rents are still high. This is an opportunity. So let's move on to the US economy and where we are today. I used to work in the news. I went to San Francisco State University, worked at the San Francisco CNN office, um, hmm, Fox and KTVU in Oakland and ABC7 in San Francisco. And I remember being a reporter and news writer. We were given very little time. You had to cover so many things all at once in that news hour that you couldn't really go deep. So, we did the best we could. But today, now I get to help those news anchors and reporters understand and interpret the headlines that can be very confusing and have been over the years. So let's see. Why is this not moving? Don't know. Oh, there. Okay. So currently, our GDP is pretty strong. We have, positive GDP. I'm going to just take a sip. Lots of talking over here. All right. So we're not in a recession, even though some people feel like we are, because prices have gone up, but their wages haven't. A lot of people's wages have gone up. But if you're on a fixed income and your wages haven't gone up, but your prices for everything have, well, then you feel like you're in a recession. Or if you're in an industry that's been hit hard, like real estate, if you're in real estate sales or mortgages, you've probably been feeling a recession. But overall, the economy is not in one. And that's amazing considering all the rate hikes that the Fed did in an attempt to slow down the economy to almost drive us into a recession. I think they almost wanted that. They even said that over the years that that's where it might end up from all these rate cuts. But it didn't happen. And that's probably from all the money sloshing around in the market. It's like they threw in an entire economy, $7 trillion, and, that doesn't just disappear overnight. That's my philosophy. So in spite of all these rate hikes to slow the economy down, it did work. It slowed the economy down, but we didn't have a recession, at least not yet. And so, of course, they held the rates. They started lowering them because job growth was slowing down. They wanted to get ahead of it. And then one little rate cut. But will they cut any more? Will they hike rates again? We don't know. A lot depends on this new administration. Generally, when an economy is booming, you don't cut rates. And if it's booming too much, you have to increase rates because that sort of balances out and keeps things from getting overheated. If the economy is too hot, that creates inflation, and we know that the Fed doesn't want that. So will they cut? Nobody knows. I have a lot of economists that come on the Real Wealth show and say they think there will be several cuts. I have others who say probably going to stay flat. And there's a few people thinking there might be actually hikes based on how heated the economy gets under the Trump administration. And if these tariffs create inflation, which they could, then we would not see rate cuts and could even see hikes. So we don't know, but safe to say we're going to probably be around here for a while. I don't see us going down to these low rates anytime soon unless we do hit a recession. Usually when there's a recession, then they want to make the cost of money super cheap so that you'll borrow it, you'll buy things and get the economy going So I don't think too many people think there's going to be a recession under the Trump administration. He's all about growth, right? So the Fed's dual mandate is, on the one hand, price stability. They do not want inflation. They want just 2% inflation. They don't want lower than that. They don't want deflation because that's really hard on business. If you know next month the price of your goods is going to be lower, who's going to buy today? They're going to buy tomorrow because prices will be lower. So it's really tough on business. So they don't want deflation. That's generally a recession. I don't want it just sitting there. So they want to see prices go up about 2% every year. And at the same time, they want unemployment to be right around 4%, 4.2% or so. Because if you have too many people working and there's, you know, not enough employees for people who want to hire, then you have to increase wages to attract people. So having too many jobs and too few workers can create inflation. So they like to see it around 4.2%. This is the target. 2% inflation, 4.2% unemployment. And guess what? That's where we are. That's where we are right now. So right now, in this moment, the Fed has really gotten to their target. They're really close to that 2%, and they're really close to that 4. Right now, it's 4.1%. So you'd call that a soft landing, I guess. They got their target. So where do we go from here? Well, you're going to see a lot of headlines that wage growth is slowing, and it is. It's slowing because it went up so much during this time when there was like 12 million job openings and people were not ready to go back to work. They were, not needing to go back to work. So we had this situation in 2022 after the pandemic with so many jobs opening back up, but not enough people who wanted them. So in order for employers to get employees, they had to raise wages. And that almost kept up with inflation. At this time, inflation was around 9%. So even though you got to pay, an increase in pay, you maybe still were behind. Well, then that wage growth started to slow down as more and more people came back to work. But then inflation came down. So inflation is down here now. So now you've got wage growth generally that's higher than inflation. So people seeing wage growth are actually in a good position today. So how does that translate to the state of the economy? Well, what we've seen over the past decade since the mortgage crisis, this baby blue lines here, these are people with a 760 credit score or stronger. So over the past decade, people who have bought homes have extremely strong credit. There was hardly any subprime. And then you can see, there were some people in the 720, 660, but very few borrowers with, bad credit. So people who own homes today have a history of paying their bills, basically. And they had to show and prove that they had the ability to make the mortgage. Additionally, people who own homes today could have refied in 2022, 2021 into a low payment. So today's homeowners are in the best position they've been in, debt versus income. Their payment is the lowest in history, and yet they've had wage growth because generally people who own homes are in careers where they see wage growth versus maybe people who didn't go to college and are working at McDonald's or whatever, and they're not maybe seeing that, or they're retired and on fixed incomes. So, like I said, 89% of borrowers today are under 6%. And look at the percentage who are in a 2%, 3% rate. It's massive. So they're just locked into these low payments while having wage growth. So that's why we're seeing people stay longer. Why would they leave? Why would they move? So we've seen US, in addition to that, 40% of people don't even have a mortgage. You've got a bunch of boomers who are in their 60s. The youngest turned 60, so between 60 and 80 years old, where, they got those 30-year mortgages 30 years ago and paid them off, and they now own a home free and clear. So it's really hard to have housing distress, to be stressed out about your house when you don't have a mortgage, It's you can't have a housing crash or even a bubble if the people who own those assets are sitting in great shape, right? In addition to that, they have a ton of equity. Look at all the equity growth, and yet fixed payments. So overall, national homeowner equity in 2024 was up 8%, $1.3 trillion richer, the people who owned. And you could see these dark areas. California saw massive growth, Washington, some other areas, maybe not as much increase in value. But overall, if you owned assets, you did pretty well over the last years. And that's why we're seeing foreclosures low, because if you have all that equity, but let's say you do lose your job and you can't make your payment, you're not just going to sit there. You're going to put your house on the market, sell it, cash in, get that equity, and go move on. So, there's not distress. Foreclosures come from distress, but there's not distress when you could just put your house on the market. Now, a lot of the headlines are also showing that inventory is up, and this is true. Inventory, you could see 2025 over here. We're beginning the year with more inventory than we had last year. So 27%, and people freak out about that, especially if that's the only thing you see on the headline. But what the headline really should say is it's still below pre-pandemic levels. Getting closer in terms of homes on the market, but we're nowhere near 2008 or 2009 when there was massive inventory and that brought prices down. So we're just kind of getting back to a normal market where you don't have to make a decision in 1 hour. You don't have to compete against 90 other people who want the same property as you. You get to go back to a market where there's time to do your inspections. There's time to, make sure, do your homework on the property and make sure it's what you want, getting your loan in order, getting your insurance in order. But even so, the long-term trend is down in terms of inventory, nowhere near where it was even in 2016. So creeping back up, but not where it has been in the past. And no one was freaking out in 2016 about about too much inventory. What we are seeing is people moving less. So during the pandemic, we saw lots of people moving from cold climates to warm climates, from high tax states to low tax states. A lot of people moving from the Northeast to Florida, a lot of Californians moving either north or, just kind of more east for affordability. But that is starting to change. And people are keeping their jobs longer. They're maybe not willing to leave their Chicago job to move to Florida because they may not know that they can get that job. So less movement. And as a result, inventory is sort of rebalancing instead of all this moving around. But as I said, inventory is still below pre-pandemic levels. So that is an issue when you have this bump, this sort of bubble within demographics, within the millennial population at first-time home buying age. So they're coming into a market where it's starting to normalize. It's starting to get better for them, but it's still in many areas a seller's market versus a buyer's market. So this is the real issue. All this demand when inventory levels are sort of below where they've been historically. And on top of that, a projected need of 18 million homes over the next 10 years. That's because, you've got new households. John Burns is predicting 13 million more households, 2.3 teardowns. Houses get old, have to be rebuilt, or they get burned, and all that stuff. 500,000 new second homes and basically already an undersupply of 1.5. So there's just not enough housing still for the demand out there. Plus, household size is declining, maybe people having fewer kids, and then the number of single-family households really increasing. And as I said earlier, people living longer in their properties. And then we have immigration. I don't know how this is going to play out, but over the last 4 years, we saw, massive immigration that created a lot more housing demand, mostly apartment demand. All right, so it is still cheaper to rent than own, like half, like 50% cheaper to rent than to own. So a lot of people are making the decision to rent or just simply can't afford double the payment. So you have this a huge group of people, you saw that bubble, that are priced out of the market and are forced to rent. Thanks for the heart. Yeah, so because it's so much cheaper to rent than to own, you have a lot more people who will be renting. And so if you're a landlord, this is an opportunity. But interestingly enough, single family rents have gone up faster than apartment rents. So I think there's just simply, like I said, there's a lack of supply in single family. So that has driven rents up in that asset class. And then going back to migration patterns that we saw over the past years over COVID, a lot of people leaving California, moving to these bluer areas, Florida and so forth. Um, that's the population gains and so forth. Migration hotspots became really expensive, like Austin. And so the suburbs of some of these areas have been a great opportunity. Coming back to the theme earlier of, is it too late? It is never too late. There's always opportunity. Following the opportunity or understanding where it is the key. So what we're seeing at Real Wealth is, yeah, some metros like Austin, you've seen oversupply. They built too many new apartments, too many, new product, and people aren't moving there. It got too expensive. But if you just move slightly out of Austin, it's a different story. San Antonio, it's not too far, and it's a lot cheaper to buy. Same with Orlando. A lot of our teams in Florida are looking outside of the metros into areas where it's still affordable but commutable. If people are forced to go back to the office, maybe they only have to go 3 days a week, so they don't mind that commute. No, it's not a 5-day commute. That's why Ocala, Palm Bay, these are areas that we've seen a lot of investors buy in because it's not the same story as Orlando. And Orlando and Tampa, they're going to hit the news of what's happening in those metros. But if you just look right outside it, it's a different story. We have a syndication we did in 2012 or something. We bought land north of Tampa, and it's called the Murata, really, really cool project there. And they've just been having record sales, but it's about an hour north of Tampa. Every month, it's like they're just blown away by how many sales they're having. Same thing with Denver. Denver's gotten incredibly expensive, but people could still move just into the suburbs. It's not one of the markets we look at, but it's an example. All right. So what we're seeing now, just in 2025, these are brand new slides, is that some areas are starting to see price appreciation slow down. And it seems to be kind of the opposite of what it was just a few years ago. It's just real estate's always cycling, it's always changing. What we're seeing now is the areas that didn't see as much appreciation are now because they're more affordable. So in this moment of time, if you're looking for appreciation, surprisingly, it might be in the Midwest area. We've got wonderful teams at Real Wealth in Ohio and Indiana and Chattanooga now so just a lot of really cool little markets. In these smaller towns that aren't headline cities, builders didn't necessarily go in and create new supply. Builders flocked to Austin, but did they flock, to Indianapolis or Fort Wayne, like some of these smaller markets, or Chattanooga, not as much. So as a result, supply is a little bit lower in those areas and prices are going up. Demand is strong because it's affordable. If you're having to deal with a 7% interest rate, which we are right now, maybe slightly under that, it's going to feel a lot different on a $200,000 or $300,000 home versus $1 million one in California, right? Big, big difference there. So these right now in this moment of time, the Midwest is really looking great. That's where we're seeing the price appreciation and cash flow. Not that I don't love Texas. Texas has been our number one market. That's where the majority of our investors are buying in Texas and Florida still, and getting getting the appreciation and cash flow and so forth. It's just a little bit more expensive. And it's the appreciation's been slowing down a little bit. But the Midwest is kind of a cool opportunity right now. So the road less traveled, I show this slide because it's so important for us to look at headline news through an investor perspective. And most of the time, it's not. The headline news is talking to someone who wants to maybe buy a home, not someone who wants to build their retirement through rental property. So we've got to think differently and almost the opposite of the masses. So an example of that is in 2022, when the Fed started raising rates and they even said, there's going to be pain in real estate. They knew that raising rates was not going to be good. And certainly in the commercial real estate world, that had a huge impact because most of those loans are adjustable. In 1 to 4 unit residential, not as big a deal because those are 30-year fixed rate loans that most people are in. So they didn't feel the effect of higher rates. But we looked at it like, wow, if rates are going up and now people can't afford to buy, every time rates go up just a little, that's another million people that can't afford to buy anymore. So we decided to start a fund being the buyer. If there's no other buyers and no other competition, that's the time. So we did the opposite. The headlines were saying, oh, there's going to be this market crash and, rates are going to go up and people aren't going to be able to buy. So stay out. And we did the opposite. We're like, well, this is the opportunity, right? If there's no competition, we can get the deals. And sure enough, the properties that we bought in 2022, in some cases, have doubled in value in just a couple of years because of our timing, because we understood the fundamentals and were able to not be afraid of those headlines. And it's the same for today. There's this concern, of course, that it's more and more difficult to buy a property, and that's the headline. That's what Trump is talking about, got to make housing more affordable. But they're talking to the person who wants to buy it. What about the person who wants to rent it and is not in a position to buy? There's just not enough housing out there for them. So instead of being scared, we have this current syndication where we're bringing on new supply in the top 10 fastest growing zip code in the country where rental properties are desperately needed. That's our current syndication, Wild Pine San Antonio, a build-to-rent community with 28 duplexes. Again, in the fastest growing city in the U.S. where that housing is needed. A syndication basically means that you're investing with a group, so you don't have to come up with a full down payment and get the loan and the insurance. You can invest $50,000 and be a part of the whole project. And at the end, we're going to sell it to Wall Street, basically an institutional investor who would buy the whole thing like a horizontal apartment. So if you're interested in that, you do need to be accredited, but you can check that out at realwealth.com/wildpine. Okay. Let me see. All right. The national build to rent trend, and this is one of the reasons why we're doing the build to rent, is that a lot of companies are not building anymore because costs have gone up. So the need for the build to rent is there, but the builders are backing off. And as a result, there's going to be this gap, this pent up demand by next year because there's just not enough new supply coming on in the rental world, and demand is going to be very, very strong. So we think we're timing this really well. This is a slide you can see from the National Association of Home Builders with Hunter Housing Economics, their forecast of pent-up demand for BTR build to rent in 2026. So we have a great opportunity to either buy it and, buy a brand new property and put it in as a rental, or be a part of our syndication where we're building those. So bringing this full circle, back in 2005, it's hard to remember, and prices seemed so cheap then. But at the time, they were hitting a new high. 2004, a lot of home prices had gone up as high as 40%. And it was becoming a very, very unaffordable time. And that's when I had Robert Kiyosaki on the Real Wealth Show, and I was kind of wondering what he was doing. And he explained that things always go in cycles. And when the coasts, a lot of people want to live on the coast, right? That's why they're the most populated, but they also get the most expensive. So when the coastal markets become affordable, well, people flock there. They love the weather of California, or they want to be on the East Coast, or they want to be in New York or whatever. So whenever there's a blip and it becomes more affordable in those markets, then you see more people, more migration to those areas and less migration to maybe the colder markets. Uh, in 2005 or like four, it had been somewhat affordable to buy and anyone could get a loan. It was really easy to get a loan. And that started to drive prices up to make it unaffordable. And by 2005, 2006, I think 2006 was the peak, prices were out of control. That's when he said, well, I'm selling at the peak. Now, a lot of people do the opposite and they say, wow, this area went up 40% last year. I want to buy. Well, you already missed it. So, a smart investor would say, oh my gosh, prices are at their peak. I'm going to sell. It's a seller's market and I'm going to go buy in a cheaper market. So that's what Kiyosaki taught me. He said he's selling all of his properties. Can you imagine the timing on that? Selling everything in 2005, 2006 in these high priced markets, selling at the peak. And he took that money and 1031 exchanged it to Texas. And he explained to me at that time, he could sell his properties and buy, four times the amount of property in a more affordable area where there's actually stronger cash flow. So he explained that Dallas, Texas was an area with the strongest job growth in the country, which then led to the strongest population growth, which then leads to infrastructure growth. If you have more people coming to the area and more jobs, you got to build more roads and then more hospitals and more schools. And all these things bring more jobs to the area. But if you can find an area like that that's also affordable, that's the key to wealth. That's the key. So you see, all right, people are now priced out of the high priced markets, but they can move to these more affordable markets. Jobs are moving to those more affordable markets because businesses need cheap places too. They're going to go where they can have a bigger headquarters, or you're seeing that all the time. Businesses moving to Texas because it's cheaper and they get tax incentives and less regulation and so forth. So in that scenario, if you can get ahead of that and buy a property where it's already growing, that's how you build wealth. And that's what we did in 2005. We left the high price market of California and we started buying in Rockwall, Texas, buying homes for around $145,000 that looked like this. I mean, you couldn't go wrong. Now, I had a woman, I talked about this on the Real Wealth Show back then, which was on the San Francisco station. And this really sweet lady called me and she said, I want to believe you, but I hate real estate. She's like, I have completely lost my shirt in real estate. She said she bought 3 properties in Stockton, California that have been just nothing but a nightmare. They were in high crime areas. She couldn't keep tenants. The rents didn't cover the expenses, $1,200 for rent on a $400,000 house. Every month she had to deal with repairs because they were old properties in bad neighborhoods. And she just said it was a nightmare. She had once believed in the dream of owning real estate and retiring on it. But she said, it's not working out for me. And so we took to look at her portfolio. And this again was 2006 at the peak. It was like, oh my gosh, this is your chance to get out and upgrade. Sell these old properties while the market's hot and get into nicer, newer homes that you don't have to worry about. So she did. She sold at the peak, sold them for $420,000 each. We were able to exchange into 9 brand new properties, like I just showed you. Because of our connections at Real Wealth and the teams that we work with, we were able to do this seamlessly and in the time that it required to do the 1031. It was really a pretty easy process to sell these and get into 9 new homes. She was able to quadruple, if not quintuple, her income because I want to say quintuple because the new properties didn't have all the repairs needed. So maybe the rents came in similarly, but with the California ones, it wasn't always steady and she had more evictions and so forth. But on the new ones, it was coming in steady, but she didn't have all the repairs. So she was able to live that dream, quit her job that was draining her. She hated that job and be able to have freedom of time because this one simple move of selling at the peak, repositioning into something that, into assets that perform better, she was able to live that dream. And we fast forward to today, and I think a lot of people have that opportunity. They're maybe sitting on older homes that have gone up in value. And if you look at the value of the home versus the rental income, it's just not working out. Maybe it worked out when you first bought it, but now would you buy that same house for that same price with the same issues that it has and the same rent, or would you do something different? And for a lot of people, once they start to look at that, what we call portfolio rebalancing, that Leah College has worked so hard on at Real Wealth to show people how to reposition. This is a wonderful opportunity to sell in the high priced markets and get into these areas like I showed you earlier that are now really performing well. So again, this woman bought these homes, 9 homes in Rockwell, just like the ones I had bought. And a year later, the properties she sold were worth a fourth of what she sold them for. They were worth like $75,000. The person who bought those paid $420,000. Meanwhile, she bought these brand new properties and they have tripled in value. So not only was she able to save her equity, quintuple her cash flow, the appreciation has been insane. She has that $1 million is easily 3 to 4 million plus the loans have paid off. So she's done very well with that one decision. So again, these are some of the areas that Real Wealth is involved in. We love Indianapolis, Cincinnati, Cleveland, Charlotte is looking real good. We've got now some new markets that you might want to look at. Again, Dallas and San Antonio have been our most popular within Real Wealth. That just keeps going. That's the train that won't stop. And then Florida as well. Still, if you can get out of the flood zones and get into sort of central Florida, that's where people want to be because insurance is lower. They don't have to worry. They don't have that flood risk or the hurricane risk. So lots of opportunity in Florida, just maybe not in some of the markets that were hot a few years ago. So at Real Wealth, we do have highly experienced investment counselors that can walk you through this process. They've done it. They've done 1031 exchanges. They've invested in these markets. They speak to, we have over 80,000 members now. So they're speaking to these people every day. They know what's working, what's not, what areas are having the best results. So speaking with one of our investment counselors is a great way to get started building your portfolio or rebalancing it, like I mentioned earlier, taking a look at what maybe you've already bought and seeing if you can maximize it or optimize it for the stage of life that you're in today. So that is my presentation. One question from Ashley. What about cost for repairs over time and property management fees? Great question. These are costs, and you need to always put those costs in your pro forma. Looking at if it's an older home, you need to set aside more money for potential repairs. If it's a newer property, then you should still be setting aside money for future repairs. It's just that you won't have to probably do anything anytime soon. You always want to set aside money for the make ready. So when a tenant moves out, it costs money to get the place looking nice and have the new tenant come in. So setting aside a portion of the rent for that is wise. We tend to tell people have at least 6 to 12 months reserves in case there was a recession in the future. We don't see one. I don't see any economists predicting that. But just having that safety, there's nothing beats the comfort of having reserves. So having 6 to 12 months set aside in some kind of liquid account, it could be in a treasury or, making some kind of yield, but it needs to be fairly liquid that you can get your hands on it. Because yeah, of course there'll be repairs and you need to be aware of that and have that money set aside. See if there's any other questions. We got a quiet group today, unless I can't see it. I don't see any chat. Nope. Okay. Well, one more question. What is your outlook for Abilene, Texas? I don't even know if I said it right. now that Stargate is investing into it? I don't know, but we have just two amazing Texas, well, actually three Texas teams that I would ask that question to. You can go on the realwealth.com website, and once you log in, you'll get the contact information for our Texas teams, and I would ask them that question. Do we still have people in Baltimore? That team decided to stop doing turnkey. They're only keeping things in house now. They're holding their property, so no, we no longer work with them. Huntsville is a great market, and we have a great team in that market. So again, it would be on realwealth.com under the invest tab. Look for the drop down there, or talk to one of our investment counselors, and they can make sure you have the contact for our team there. It's Huntsville's always been kind of hard to get inventory, but if you can get it, then great. Next question, will any project on the way that is near the chip productions in Arizona? We don't currently have a team in Arizona, even though we're really not that far from Arizona. I would love to have a team there, but so far it's just been a little more expensive than we like. So when we compare markets, Arizona is a great market. But if I can be in a market that's growing as quickly, but the cost of the property is like half of that, I'd rather do that. So currently we don't have a team there, but man, if you know someone, let us know. Do we have multifamily homes? Yes, we do. Our San Antonio team has them. Again, talk to our investment counselors. They'll be able to direct you to the teams within Real Wealth that we can refer you to that sell multifamily. Someone said, good to see you in San Francisco. Thanks for offering this again. Need to hear things more than once. Take care of your voice. Yeah. I came home to the Southern California area, and of course there's another fire just over the hill. We've had 2 weeks of insane winds. Our electricity's off. I'm on solar power right now, which is awesome. Highly recommend it. But I think that smoke is getting to me. You mentioned Ohio is a good market. I love Columbus. Yes, I love Columbus. We just don't have a team there currently, but we do have a team in Dayton, Cincinnati area, and Cincinnati and Cleveland. But we'd love it to have a team in Columbus. It's certainly a great market. When you say Midwest is a good market, should I be buying new or rehab property? Most of the Midwest properties are going to be older because a lot of builders did not build there. So a lot of them are rehabbed. However, the Indianapolis team is building new properties. So again, I would speak with our investment counselors to find out where you might be able to buy new properties in the Midwest. But for the most part, they tend to be the older homes, but not always, or fully renovated. Do we still work with Missy in Ohio? Yes, she was just at our last event, and she's awesome. Do you still have properties in Chattanooga? Yes, you can just go on the drop down on realwealth.com to find that team. Again, or talk to one of our investment counselors who can make sure that you get in contact with that team. Lots of great questions. Thanks, everyone. If you have more questions and our hour is up, feel free to send those over to your investment counselor or to, it's a good question. Is it hello at RealWealth? Maybe hello at realwealth.com, or just go on our website. But ideally, speak with your investment counselor. Do we have a team in Colorado Springs? No, I love the idea. One of our investment counselors lives there. It's kind of an expensive market. We haven't found a way to make those numbers work because first and foremost, we seek cash flow. We want to make sure that at least the property is covering itself, that you're not having to feed it and pay more, pay towards it, that you want it paying you. So we try to stay in more affordable markets. Love Colorado Springs, but it's just gotten more expensive. All right, everyone. Well, thank you. Send your questions in. We'll be sure to answer them. Really appreciate you. It's so great to see so many members at our Real Wealth event. We'll be having more events. Tours, property tours are awesome. You get to go and actually see the market, meet the team, go check out the property management. Have a wonderful day, everyone. Thank you so much for joining me. Bye-bye.